Welcome to Every Dollar Counts with Josh and Jay, a shot of truth serum for your investment and insurance questions. I'm Josh Knoll, the owner of Gulf Coast Financial Advisors, and I'm joined by my co-host, Mr. Jay Stubbs, director of the Gulf Coast for Concourse Financial Group. We're brought to you on the Gulf Coast Financial Advisors Podcast Network. Well, Jay, we've already thrown the baby out with the bathwater on time-stamping our podcast episodes.
We have.
Yeah, that's gone. Previous episode, we decided, ever since COVID, we've had opportunities to do evergreen topics, but the world has changed so much so rapidly that I think our listeners really count on us to have more current type of topics to discuss. So that's what we're doing right now. We're sitting here in June 2022. It's already scalding hot down here, about to get hotter down here on the Gulf Coast, Mobile, Alabama. And we've got pretty much a full-blown correction going on in the stock market. We've got rising inflation, and we've just got consumer sentiment and a bunch of political things all at play. And so what Jay and I are trying to do with a little three-part series here is to talk about maybe some of the fundamental reasons for that, and maybe hopefully give you all, if not necessarily some peace of mind, but maybe a better understanding of what's going on. So in this particular episode, we're going to talk about what the difference between a bear market and a bull market is. And the reason we're doing that, because there's an old saying where folks say that people make their fortunes in a bear market or a down market, and they're collected in a bull market. Well, that's all well and good, but how do you tell when you've reached bottom, or how do you tell when you've reached top, right? And is there any point in time when you should cut your losses? So we're going to dive into that. This is going to tie into our previous episode where we talked about fear of missing out, and it will also segue into our next episode where we talk about inflation. But before we get into all that, let's have our friends from Sloth Racer kick us off. Jay, my friend, what's going on?
Josh, doing just fine. Good to be with you. Good to be here in Deep Fried Studios, downtown Mobile, with our good friend and producer, Johnny, and his staff, which outside looks like two four-legged friends.
That's right.
They look like they're nice and cozy and cool as opposed to being outside.
That's right. Well, quick housekeeping for compliance. Jay Stubbs and Concourse Financial Group are not affiliated with Prime Capital Investment Advisors or Qualified Plan Advisors or Gulf Coast Financial Advisors, and Josh Knoll is not affiliated with Concourse Financial Group. So, Jay, here's what I want to talk about. Again, we threw the baby out with the bathwater when it comes to time stamping these episodes. We're on the heels of a significant correction. We have now officially entered bear territory. This episode, this is going to be a quick hit, listeners. We're going to talk about what is a bear, what is a bull, why do they say fortunes are made in a bear market and collected in a bull, and how does that relate to the topic we had in our previous episode where, okay, that all sounds great, guys, but can you tell me when I'm at the bottom of the valley or the top of the mountain? And if you can't, then when do I decide I should cut my losses if I'm in certain positions? So with that said, Jay, what I'm going to do, I'm going to frame up what a bear looks like, because that's what we're in, and then we'll segue into that, into the bulls and some of the things that we've seen happen here recently. So a bear market, quite simply, is a general term that when an index like the S&P 500 or the Dow Jones has fallen 20% or more from a recent high for a sustained period of time. So to say we're in a bear market, we're tiptoeing into a bear market. I guess technically you say we're in a bear market, but we're just starting to get into it. We don't know how long it'll last. We just know that we've hit the mathematical definition of a bear market, right?
Yeah, it's been a brutal year for stock indices. Everybody's seen it. It's been in the news. It's been on social media, and you can't get away from it. If you flip on any of the news channels, you see the red. But when the market has its correction and enters bear, that's what we're in. So, timestamp June 13th, with the drop on Monday, June 13th of the S&P 500, it dropped 3.9% and ended at 21.8% below its January 3rd record closing high. And you just stated it. By going below or having a drop of more than 20%, you're now officially deemed into a bear market.
Right. All right. So on the flip side, that's a bull market. Now, bull market, in my opinion, is a little less tightly defined, but the commonly accepted definition would be stock prices rise 20% after two declines of 20% each. Now, that could be over a significant amount of time. That could be in a short amount of time. Here's my opinion, having been on this earth for multiple decades at this point and having been through both bear and bull markets. I think a bull market is usually defined by the attitude of the investing public. If they think things are getting better and prices of their individual securities or bonds are going to rise, it tends to be a self-fulfilling prophecy, and we tend to go into a bull market. If they have a negative sentiment, and that is correlated with the market actually reflecting that by sell-offs and consolidation down into a bear market, then again, somewhat of a self-fulfilling prophecy, although there are some fundamentals at play.
Real quick, I want to point out, some people are like, well, how long does a bear market last? We know we're into bear territory. How long is that going to last? Well, if you go online and read and some of the more reputable news sources, you'll find at Reuters.com, it's taken a little over a year on average for the index, the S&P 500, to reach its bottom during a bear market, and then roughly another 2 years to return to its prior high, according to this article. So there's been 13 bear markets since 1946, and those averages have been identified. It takes roughly a year to get to the bottom, and then we have a 2-year average time frame to get back up. Is that to say that this is going to happen in 2022, the remainder of, in 23 and 24? Who knows? We don't know the answer to that question. All we can do is look back at history, and things today are much different than they were in 1946.
Yeah, 100%.
I mean, we're just coming off of World War II. We were heavy on a lot of American sentiment, American-made goods, just defeating the Germans and the Japanese in the war, reestablishing the American dominance in the world. Things were looking pretty good, but then we had to go and pay for everything. And so a lot of positive things happened, and then we hit bear market territory, and then we've had 13 of them since then. We've just hit one again in 2022, June 13th, and who knows how long it's going to last. And we just need to be prepared mentally that maybe, just maybe, if I can put some money into the marketplace, or maybe have a conversation with a financial advisor, maybe something that I'm getting in at a low point, and I've got time on my hands, and I've got a risk tolerance, maybe, just maybe, I can have an upside potential.
Well, allow me to go to Nerdville real quick, Jay, but there is a theory out there. I don't hear much of it anymore. Maybe that's just a reflection of my age and when I went to college, but efficient market theory, where stock prices are supposed to reflect all the fundamentals of the company underlying it. Their revenues, their profits, their cost of goods sold, their inventory, all that is supposed to closely or near perfectly translate to that stock price. Now, does that happen? Are there fundamental investors out there? Warren Buffett would be, I think, a great example of looking at, what is the stock price relative to the fundamental value of that company? Sure. But I think most people would agree that emotion plays a significant part in the valuation of the stock market, both good and bad, up and down, right? And so the reason I bring that up is part of the reason people say that you can make your fortune in a bear market is because typically the negative expectations and negative attitudes toward the market swing as a pendulum too far one direction. And all of a sudden you find yourself into where you could, if you did the fundamentals on a particular position or group of securities, potentially even seeing where the company is undervalued. Now, that all sounds good. These are things that very complex and very in-depth investors, again, referencing Warren Buffett would do. Not Warren Beatty. I don't think he's doing lots of that.
No, wrong Warren.
Wrong Warren. But these are things that these people do. Do you have time to do that? Does the average investor have time to do that? Not necessarily. What Jay's referring to is you never can call the perfect bottom of the bear market until you've already passed it. You have to see it in the rearview mirror. That's the only way you've got 20/20 vision on it. But if you are a long-term investor, at least a reasonably long-term investor, when you see things take such a negative turn, as long as you believe in the future of America, there are potentials where maybe you're buying something that proves to be a discount over a year or 5 years or 10 years or whatever your time horizon is. That's what they generally mean when they're saying fortunes are made in a down market, because you can buy a security, and in a efficient market theory, which we all agree, or at least I agree with myself, doesn't necessarily exist, that thing, as long as the company remains profitable, increases profits, increases market share, that stock price is going to naturally go up over time. Well, that's all well and good, except that it's so hard to get that data translated in that efficient of a manner. What you're betting on is that emotion has taken the pendulum too far the other direction, and now what are quality companies, long-standing companies that are going to be here on the other side of this bear market are still going to be there and still be profitable right now, maybe trading at a long-term discount. That's my opinion. What say you, Jay?
Yeah, so let's bring it in for my famous analogies. When we are looking at a pair of shoes and we think, hey, I really like those boots. I like those shoes. I want to get those. Oh, man, those are a little too high. I may wait till those go on sale, or maybe I get a coupon and I can go get them for a discount. Much in the same fashion that we look for bargains in the marketplace, might be big items, might be a house and need to get the right price on the house, or a car, might be let's get the right price there, might be an everyday item, might be milk. Shoot, I mean, some stores, milk's much higher price than other grocery stores. Same thing holds true when you're thinking about it, trying to draw an analogy with respect to the market. Are we getting things at a discount? Are we getting things that still have value in the future, but they're priced lower now than they were 6 months ago? And if once you have a consultation, sit down and gather some advice, do your risk tolerance, maybe you can design a portfolio that it's all at a discount today.
Right. Very good. Now, on the flip side of that, Jay, the bull side of it, when do you call the top of the bull or an up market? Well, I can tell you this, if anybody on earth could actually call that with consistency, they would be the richest person in history by trillions and trillions of dollars. It's impossible to call the top, just as it's almost impossible to call the bottom until it's in the rearview mirror. But what we have seen with the rise of the bull, and now what appears to be, at least if nothing else, a correction, possibly the beginnings of a recession, if we go that direction, is you're starting to see what translates back to the previous episode to this one that Jay and I talked about. A lot of how you feel about the top of the bull or the bottom of the bear and missing out is related to what kind of positions you have and what is your investing strategy. Do you have a strategy, or were you just investing to try to catch the next big thing? In our previous episode, we talked about folks that were heavily invested in individual stock, one or two stocks, the majority of their holdings being held there. I even mentioned penny stocks, which probably makes me sound 100 years old because I know they still exist, but they aren't the thing that they used to be back when they were in the dot-com era. Meme stocks, which on the other side makes me sound 100 years old because I only have a loose understanding of what those are. And then crypto. So if you have those positions and you're seeing things, not only are you seeing the probably an outsized proportional loss related to the rest of the market in those heavily concentrated areas, but you also have a little bit of fear of, man, this thing may not come back, right? Especially if the underlying company is not appear healthy or does not appear that it's going to be healthy for a long time period. So that's going to really contrast to the folks of you out there that are more diversified portfolio and or have a longer time horizon. You're seeing things, you're probably seeing your portfolio get beat up some, but maybe not necessarily directly correlated to the S&P 500 because you're probably not in 100% equities. You probably got some losers, but not all losers. And two, you've set this up in a particular plan to where this money had a purpose. It wasn't just trying to get you rich quick and easy, which happens. I'm not trying to dissuade anybody from that. If you can do that, pull it off, good for you. But for the majority of the investing public, they're just trying to have something that is poured in concrete, not poured in quicksand. And they're trying to build a portfolio that's going to last even through these bear markets. Because guess what? This won't be the last one, right?
No, I mean, we've certainly seen 13 since 1946. Granted, that's over a 60-year time frame that we're now experiencing. So we'll see more. The issue is people need to be properly diversified, properly allocated, and proper risk tolerance. We can keep beating that over your head. We just need to keep beating that through the speakers, in your car, in your earbuds. If you are not happy with where you ended up today, middle of June of 2022, because maybe you've done it on your own, or maybe you did the individual stock or individual company approach, or maybe some alternative investment strategy, maybe it's time to sit down and have a conversation with somebody.
That's right. All right, so Jay, I'm going to start landing the episode this way. So two points. One, we made it on the last episode. If you're an existing investor and you were in a heavily concentrated position that typically maybe was not what you normally did for your investing career, or maybe you were first time into doing some of these things, and even worse, maybe you felt pressure to get in as the market was starting to top out, and now you're seeing even greater losses than if you had been in for the last couple of years. For folks like that, I'm going to tell you, don't give up. Nobody's going to be able to tell you when exactly you should cut your losses. It comes down to the pillow test. But if you're tired of staring at your phone all day long and watching this thing, which I know it was thrilling when everything was going up and up and up, and you got tired of old guys like Jay and I and guys older than us saying that this won't last forever, if you're tired of that whole roller coaster, then maybe it's time to catch your breath and maybe look at diversification. And the other thing too is there's no perfect timing to get in the market. Jay and I, in our industry, there's a common joke. The best time to invest in the stock market is 20 years ago and today. Again, as we've previously stated, we don't know if we're at the bottom of the bear, but we do know that as long as you believe in the future of America, there is potential for some long-term discounts on quality positions if you're willing to come in and actually take those chances, if you will. Make sure you buy quality and make sure you've got at least somewhat of a long time horizon so that you can ride out what may be a little bit of a rough ride until we get back to altitude. So those are really kind of the two takeaways I have on this, Jay, as it relates to weathering a bear and a bull market. I'll give you last word.
Well, when we do your own Google searches, find your definitions, but then once you are done searching for things on your own, sit down and have a conversation with somebody like yourself, Josh. But at age 45, I got into the business in the dot-com bubble. Then we had September 11th. And we saw the fear in the marketplace then, especially in the travel industry. Then we got into the mortgage 2008, 2009. Josh, you have a very deep and personal history there. And then we've been riding pretty daggone well since then. And then we hit COVID, and we had a sharp decline and then a rapid increase right after that because there was a lot of positivity pumped into the marketplace, a lot of liquidity pumped into the marketplace, and people figured out how to go make money. And now we're in a different world. We're in a different administration. We're in an inflation setting, to set the tone for the next episode if you're listening to this. And there's a lot of uncertainty going on, not only in the world, but also in the United States. Calm and education are your two biggest proponents in an investment type of mentality. Sitting down and having a conversation with somebody to understand the ins and outs of how your portfolio would work if you did this or if you didn't do this. But at the end of the day, I really do appreciate the fact that 25 years of experience, you in two different industries with over 20, 25, 30 years of experience, you can really have put somebody at ease. But time, make sure you've got the proper time for your portfolio. We're not looking for short-term wins. We're looking for long-term opportunity. As you near and get closer to retirement, your retirement portfolio is going to change. The diversification of it's going to change. The allocation of it's going to change to a little bit more conservative or a lot more conservative. And so if you're young and have plenty of good cash flow and job is good, maybe you're in a good spot and you can start taking advantage of some of these down prices.
That's right. Catch your breath. What's the purpose of the money? If the money's not needed for 20, 30, 40 years, then chill out.
I've got a qualified plan. I've got a 401k, and I can't touch that thing till I'm 59 and a half without penalty, right? So why wouldn't I be a little bit more, for lack of a better term, aggressive with that portfolio? Why wouldn't I reallocate some of those funds in something that has now down year to date? I'm only going to hopefully maybe I'm going to capture some of those upside gains over the next 20 years.
That's right. Very good. Well, great way to end it, Jay. Thank you. Listeners, if this topic applies to you, we can help. You can reach out to us to start the conversation by calling 251-327-2124. Leave a message if you don't reach me. Plus, you can visit gulfcoastfa.com. That's Gulf Coast, FA as in financial advisor.com. For all you independent and semi-independent advisors and agents out there listening and interested in the value that Jay Stubbs could bring to your practice like he does mine, you can find him at jaystubbs.com. That's JAYSTUBBS.com. So many thanks to our producer, Johnny Gwynn, down here in Deep Fried Studios, downtown Mobile, Alabama. Many thanks to my co-host, Jay Stubbs. And as always, Jay and I want to send a huge shout out to all of you that have joined us on this journey. And of course, to those who've joined us now, do me a favor, please subscribe on the Apple Podcast app or wherever you get your favorite podcasts. And while you're there, you would be doing us a huge favor if you would rate and review the show. It helps other listeners like you find us. Lastly, if you like the show music, go check out slothracerband.com. That's slothracerband.com. And they're going to take us home now. This has been Every Dollar Counts with Josh and Jay. Advisory services offered through Prime Capital Investment Advisors, LLC, PCIA, a federally registered investment advisor. PCIA, doing business as Prime Capital Wealth Management, PCWM, and Qualified Plan Advisors, QPA. Gulf Coast Financial Advisors is independent of Prime Capital Advisors. Information presented for educational purposes only, is not an offer or solicitation for the sale or purchase of any securities. All investments involve risk, and unless otherwise stated, be sure to consult a tax professional before implementing any tax or investment strategies.